They didn't panic. They didn't miscalculate. They executed a year-end liquidation by the book, and the damage you're seeing on your screen is the consequence. They chose their timing carefully, not weeks ago, not even days ago. They waited until liquidity was at its weakest, until participation was thin, until most traders were mentally checked out for the holidays. And then, on the final trading session of the year, they acted. What you're witnessing right now, those sharp red candles, that sudden collapse in price, is not random chaos. Silver trading near 7D50, after touching 75 just hours earlier, feels brutal. For many investors, it feels personal. You endured the volatility, you believed the breakout was real. And now, just as the calendar flips, your portfolio looks wounded. But what's unfolding here is not a failure of the thesis. It is not the end of silver's bull cycle. This is a forced liquidity event, a mechanical rush for cash triggered by regulatory deadlines. It is accounting pressure, not fundamental weakness. The sell-off is being driven by rules that compel the world's largest banks to slash exposure and stockpile dollars before midnight on December 31st. This is the final flush of the year, and it's deliberate. To understand today's price action, you have to step inside the mindset of a global bank on December 31st. This is not a day for speculation or positioning. It's a day for compliance. At the stroke of midnight, regulators take a snapshot of every major institution's balance sheet. That snapshot determines capital charges, leverage ratios, and most importantly, systemic risk scores, the infamous G-SIB classifications. The higher a bank's risk score, the more capital it must lock away, often to the tune of billions of dollars. Holding volatile assets on that day, commodities, equities, even certain bonds, raises that score. Cash lowers it. So the incentive is clear. Sell risk, raise liquidity, show dollars. Gold, silver, equities, treasuries, anything that inflates balance sheet volatility becomes expendable. The selling you're seeing is not an opinion on value. It's window dressing. This is why the decline is so violent. Markets are thin. Participation is low. A relatively modest order can move prices dramatically. Dump 1,000 contracts and silver slips. Dump 10,000 and it cascades. The intent isn't price discovery, it's balance sheet hygiene. Once the clock strikes midnight, the regulatory pressure vanishes. And historically, that's why the first trading days of January often bring sharp reversals. The same institutions that sold into weakness re-enter once the rules reset. Gold confirms the story. Trading near 300 and down more than 70 earlier on the day, gold's move signals macro stress. When gold weakens abruptly, silver amplifies the motion. A 2% move in gold can translate into an 8% swing in silver. This correlation tells you something critical. This is not a silver-specific collapse. It's a dollar-driven liquidity squeeze. When banks liquidate assets to raise cash, demand for dollars surges. The dollar index rises, not because the economy is strong, but because the system needs dollars to satisfy year-end requirements. That surge acts like a wrecking ball across all dollar-denominated assets. But liquidity crises are temporary by nature. The Federal Reserve understands this. Repo facilities exist for this exact reason. Fresh liquidity tends to appear just as pressure peaks. From a technical perspective, the damage looks ugly. The chart has printed a massive red candle. Short-term uptrends are broken. Momentum traders are forced out. Algorithms react mechanically, selling because price is falling, not because value has changed. This creates a feedback loop. Support levels are tested quickly. Right now, the 70 area is critical. It was resistance for weeks. Now it must become support. If this level holds, the entire move down becomes a painful but valid retest. Former ceilings often become floors. Volume behavior matters here, and the data shows absorption. Each dip towards $7 is met with aggressive buying. That's not panic. That's accumulation. Someone is willing to stand in front of the selling pressure and say, "I'll take it here." That someone is forward-looking capital preparing for the next phase. Emotionally, days like this are exhausting. You saw 75 yesterday and 70 are today. It feels like loss, even if you haven't sold a single ounce. But markets don't transfer wealth through logic, they do it through psychology. If you didn't sell at the highs and you aren't selling now, nothing has actually been lost. The ounces remain the same. The market is simply testing your patience. Ask yourself what truly changed. Did global debt shrink overnight? Did industrial demand disappear? Did mining output suddenly surge? None of the fundamentals shifted. Only the price did. And price in moments like this is noise, loud, painful noise, but noise nonetheless. Now look at the physical market. If spot silver is 70 or 50, logic suggests coins should be cheap. They aren't. Dealer premiums have expanded. Instead of narrowing, they've widened. Why? Because physical sellers understand the difference between a paper flush and real demand. If a dealer sells inventory cheaply today and prices rebound tomorrow, replacement becomes impossible. So they hold firm. That divergence, falling paper price, steady street price, is a signal. Physical supply remains tight. There is no rush to sell real metal. Industrial users reinforce this floor. If you're a manufacturer with a silver budget, today's dip is a gift. Lower prices reduce input costs. Buying accelerates. That demand is not speculative, it's consumptive. Metal that enters industrial use doesn't return to the market. It disappears. And that transfer from weak hands to strong hands deepens the structural shortage. Short sellers, meanwhile, may have temporarily regained control to force the price down. But in doing so, they likely re-entered positions they had only recently exited. That rebuilds short interest, and every ounce sold short today becomes an obligation to buy back later, often at higher prices. The trap resets. January magnifies this dynamic. New money flows into markets at the start of the year. Pensions, endowments, retirement contributions. In December, liquidity evaporates. In January, it returns in force. When that capital hits a suppressed price, reversals can be violent. This is the slingshot effect. The deeper the pullback, the stronger the snap. Could prices fall further? Technically, yes. Support near 68 exists. A retracement of that magnitude would still be healthy in the context of the broader trend. Emotionally devastating, yes, but structurally normal. Corrections feel worse than they are because they erase recent gains. But value does not move in tandem with price during liquidity events. Tax considerations add fuel to the fire. December 31st is the deadline for loss realization. Funds sell losing positions not because they dislike the asset, but because they dislike taxes. That selling vanishes the moment the calendar turns. On January 2nd, the same managers often rebuild positions they were forced to liquidate days earlier. Mining equities reflect this stress most acutely. High beta works both ways. They fall harder during panics, regardless of cash flow strength. Valuations can detach entirely from reality. For prepared capital, that dislocation represents opportunity. Zoom out further and the macro backdrop becomes even clearer. Bond yields spiked as banks sold treasuries to raise cash. Higher yields tighten conditions briefly. But with debt loads at historic extremes, sustained high rates are impossible. The higher yields climb, the faster central banks are forced to respond, and response means liquidity. That liquidity ultimately finds its way back into hard assets. When markets reopen after the holiday, the selling pressure tied to regulation and taxation disappears. Buyers return to an emptier order book, gaps form. Prices chase liquidity upward instead of downward. The same mechanics that caused the crash enable the rebound. Physical delivery data supports this interpretation. Open interest remains firm. Buyers standing for delivery have not fled. They're content to take metal at lower prices. That's not speculative behavior, it's necessity. Vault drains continue quietly beneath the noise. The psychological toll is real. Watching red screens drains emotional capital. But conviction is built in moments like these. Turning off the screen doesn't change the outcome, but it preserves clarity. The thesis that led you here hasn't been invalidated. The timeline may feel compressed or distorted, but the destination remains. Globally, these dips often coincide with eastward flows of metal. When Western markets sell, Eastern buyers accumulate. Price weakness facilitates that transfer. History tends to remember these moments not as failures, but as inflection points. So what comes next? The structure of this sell-off points toward a V-shaped recovery. Event-driven selling ends abruptly. Value-driven buying resumes quickly. A reset like this can actually extend a bull market by relieving excess enthusiasm before it turns destructive. Short sellers who profited today know better than to linger. January punishes complacency. Covering adds fuel. Ratio traders notice silver cheapening relative to gold. Industrial buyers notice discounts. Funds deploy fresh capital. Pressure flips direction. Sideways consolidation may follow, a necessary bridge between fear and momentum. Patience is required. But sideways is not bearish. It is preparation. Zooming out even further, global liquidity trends remain supportive. Central banks worldwide are easing. Money supply expands over time. Hard assets track that expansion, regardless of interim volatility. In the end, the number on the screen is temporary. The metal itself is permanent. Its value is chemical, industrial, monetary, and historical. Price fluctuates. Utility does not. This final trading day of the year was a test, not of silver, but of conviction. The flush is nearly complete. The regulatory pressure expires. The calendar resets. And with it, the conditions that force this sell-off disappear. What follows is not guaranteed, but the odds favor reversal. The slingshot has been pulled tight. The release is approaching. The year ends with turbulence, but the structure holds. And when January opens, the market will decide who is patient and who was shaken out at the worst possible moment.